Hello and welcome. You're with us on BTTV. I'm Aabha Bakaya. With me is Sunil Damania, CIO at MarketsMojo. Markets this afternoon down 600 points, looking a little weak this afternoon. Real estate is on the downtick, as are PSU banks. So in fact, a lot of pockets where we've seen some traction, seeing a bit of a reversal coming in today's trade. Sunil, let me get your view in on this. What is really happening to these markets? Just when we thought that all was lost, they've made this fantastic comeback. And now again, we're seeing a little bit of I don't know what to call it. Do we call it profit booking? Do we call it a reversal? Do we call it weakness? What are we calling it?
Afternoon, Aabha. I think that's the nature of the market. Sometime it will move up and sometime it will go down. I think one big concern today, everyone is talking about that FOMC is going to declare the minutes of the meeting that held in December. And people don't know what would contain. Would it give some sense of whether should we expect more rate hikes, which is bound to be there on 1st Feb, but what could be the quantum and what could be the trajectory of future rate hike from the Fed if market can get some sense of that from the FOMC meeting. My sense is that it's more of a profit booking as we speak, especially in the mid and small cap space, because if you look at last 1 week, I think mid and small cap did extremely well as compared to large cap. That was not the case for the full 2022. But last week, definitely we saw some buying interest coming in mid and small cap. Also, the PSU bank that had run up extremely well. And I think there is a need some kind of a course correction that need to take place. But I think one more thing which Aabha, it seems to have come out when you look at some of the business updates that has come from some of the banks. And one trend which clearly looks very prominent is that credit deposit ratios keep on increasing. And at the same time, if you look at the CASA as a percentage of deposit, that is continuously coming down. In other words, the names are going to be a little challenge for the banking sector. Why? Because you are not able to get deposit at the lower rate, and that's going to impact your name. So I think that one concern will definitely play out in the investor's mind, and that could be one reason why we saw some banking stocks coming at some kind of a pressure today, especially on the PSU front.
Okay, it's interesting. I mean, just for the sake of argument, so many people have been recommending that we stick to the frontline names, for safety in the market. But when we're looking at, the index contribution, I mean, we're seeing pretty much broad-based selling coming in even across the heavyweights. Do you feel perhaps there could be pockets within the broader market that would still be relatively insulated, just on the strength of the specific stories? Or do you feel that there is merit to perhaps sticking with safer plays in a volatile market like this?
So there will always be some place where someone can definitely take some kind of this. But that's it. See, what has happened in last 1.5 years or so, Abha, is that sector rotation has been the name of the game. So sometimes some sector would do well, some sector will not do well, and so on and so forth. And within that, you will see some companies doing well and so on. So I think if you're taking a daily call, then it becomes really difficult for someone to really take a call on what needs to be done. But our house call, as we go into 2023, does give the feeling that IT, which has really underperformed very significantly in 2022, which was not the case in 2019, 20, or 21, but it was down almost by 20-21%. I think that it seems that a lot of negatives are already priced in terms of the valuation, in terms of the attrition rate that complete IT sector gone through. So I think IT sector seems to be more favorable in terms of risk versus reward. Why? Because all negatives are already there in the price, but upside potential could be positive. That's one sector we believe could be where someone can actually park funds to make some decent returns in 2023.
Okay, it's an interesting view coming in on IT, given that everyone's been talking about its, potential reward scenario going forward. And we're heading in for earnings too, so let's see what kind of cues we get from there. Does the attrition rate in the IT sector worry you at all, given that that's been a big talking point of rate, Sunil? Just wondering.
Sorry, can you come again? I just missed you in between.
I said the fact that a lot of these IT majors have been dealing with a very high attrition rates, and therefore, there is expectation that will also lead to further costs because of just the fact that they need to spend on recruiting. It's been such a big talking point of late. To you, is that a pain point for IT at all, or is it just really limited to what we're seeing in the global scenario?
No, my sense is that attrition rate has started coming down. It's not going to go up. So if you look at some of the commentary that was there in September quarter, some of the companies have given indication that either they're at the peak or it's about to fall. So I think the kind supply side constraint that we saw with the IT sector in 2022, it should be behind, it's more in a rearview mirror. That's number one. Number two, even if you look at some of the startups, they've started asking people to go because there's a winter funding, and that was also creating some amount of pressure for the IT companies to retain some of the good employees. I think that pressure is also gone. So my sense is that the commentary as and when this company start coming down from next week, starting with TCS, we would see a lot of positive comments coming from the CHRO, that's the head of HR department, giving a lot of sense and sort of relief to the market that what we were expecting, and companies were buying or trying to retain employees by giving BMW bikes and so on and so forth. I think this is all in the history book now. We don't see this kind of a panic situation for the IT company. So that one headwinds which everyone was worried about attrition rate, I think is not going to be there. And of course, we'll get more clarity by next week when the IT companies start declaring the numbers.
Okay, interesting. On the financials, where are you placed with regards to PSUs versus private sector names? We also saw a sudden spurt in life insurers randomly earlier this Monday. Not sure what led to that. But, they've otherwise been a little quiet. But within the private and PSU banking names, where would your interest lie?
So definitely today, the flavor of the season is PSU Bank. And whether we like it or not, they are just surging ahead. And even if you look at the price to book value, they were commanding maybe 6 months back or so, they were really very, very valued at a very attractive level. I think a lot of good things are already there in the price. So my short-term view, definitely PSU banks should outperform versus the private sector bank purely because of there is a lot of hope that we could see some kind of a reforms happening within the PSU bank, and that could benefit PSU bank, number one. But on a longer term, medium to longer term, I think PSU bank would struggle to outperform for the very simple reason. I think the name of the game is technology, and somewhere PSU banks are a little behind the curve in terms of deploying some of the top of the notch technology, and that's where they are going to lose out on the market share. They are going to lose out on the CASA deposit and so on and so forth. So I think and this technology challenge is not only going to be there for the public sector banks, but also for the private sector banks. Why? Because some of these fintech companies are going to become a big competition to some of these complete banking sectors. I think I see a lot of churn that's happening in the financial space in next couple of years. So short term, yes, PSU bank looks attractive purely because of price to book value. They're able to maintain their CASA ratio. Credit seems to be growing at a decent pace, and that's a thing and so. But that's more of a short term. I think even if I have to take a bet on 2 years time horizon, I wouldn't prefer PSU bank in the portfolio.
All right, so that's on PSU banks. That's the verdict coming in there from Sunil. Thanks, Sunil. What about infra and capital goods, infra, that entire pocket? Is that looking exciting to you, given the huge bets that we're taking on India's growth story and resurgence there, and the fact that there is so much capex that's still anticipated?
Definitely, yes. And if you look at the history, whenever there is a general election, which would be there next year, I think government normally spends a huge amount on the capex and the infra projects just 1 year before the election. And that's going to come in this year. So that's going to definitely increase some of the infra projects, allocation to the infra projects. Second thing, if you look at recently RBI came out with the report suggesting that capacity utilization in the economy is 75%. And that's a good decent level where private capex would also start increasing their capacity addition. So I think those two things makes me believe that the capital infra and capital goods sectors would do extremely well. They have been clear-cut underperformer from 2008. And if you look at some of the companies' valuations have become really very, very attractive at this point of time. So they've reorganized their balance sheet, they've redone their leverage position. And now whatever who are there in the business, I think they are more sustainable, more manageable balance sheet. And with the kind of capex that we look from the government as well as from the private, they really make them very, very good buy for 2023.
All right, so that's the view coming in on some of those infrastructure. Any expectations from the budget this time, Sunil? And also, actually, before we get to the budget, from earnings season, what are the cues that you're going to be watching out for?
one definitely. So first, let me address the budget because that seems to be the clearly hot topic for everyone. So whenever I look at the budget, I always expect government continue with the policy action they've been doing from last many years. So they should not disturb anything. The one thing which I would wish if finance minister can oblige with that, this is that no tinkering with the capital gain tax. If you remember, Aabha, last year same time, there was a lot of fear that capital gain tax will go up from 10% to maybe 30% or 15%, and it spooked the market sentiment. I wish there's a cost of indexation which came in a couple of years back where grandfathering happened, and there was no cost of capital. There was no inflation was allowed. Cost of indexation was not allowed. I wish this time finance minister allow on the grandfathering date that 1st January 2018 they allowed the cost of indexation. So what happens? The capital gain tax which that investors need to pay goes down. So that's my budget expectation. Otherwise, I do expect government to spend a huge amount or allocation to the capex. One more thing, I think inflation has hit us everyone very hard. You, me, and everyone. And we have not seen any kind of relief in the personal income tax bracket. Of course, we did see something on the corporate tax couple of years back, but nothing on the personal tax. I do expect government to consider that inflation has really taken away the larger chunk of the disposable income of the individuals. So they should give some rebate debt. So these are two major expectations from the budget. Coming back to the results, I think one thing which clearly makes me a little hopeful that we had seen a lot of input cost pressure for the India Inc., whether it was the June quarter, whether it's December quarter. And despite so many metals or so many other input costs started coming down, the Indian did not get the benefit. Why? Because they were carrying higher inventory cost in their books. And since they use first in, first out, FIFO method, it did not reflect in their profit and loss account. My sense is that margin will definitely go up for the Indian for the December quarter. And that's one thing which I'm closely going to watch out for, because that will really give an idea that India can maintain and can sustain the higher margin. If that happens, I think that would be really push the market and indices to a higher level.
Great. Sunil, what's your ideal portfolio mix right now? I know you don't want to talk stock specific, but if you had to give us ideal mix, what would it be?
So our sense is that I did an analysis, and that analysis tells me that if you look at the historically, mid and small cap accounts for on an average 15% of the total market cap. If you look at the end of December 2021, that is last year, it was almost about 10%. And as of December 2022, it just accounts for 5%. That clearly gives me that law of average should kick in, and the mid and small cap should do extremely well in 2023. And if that is so, I would rather prefer to have 60% of my portfolio consist of mid and small cap, and maybe near about 40% in the large cap. So that basically completely balanced risk versus return kind of a scenario in my portfolio. So that's what I would recommend to the retail investors also, where they can go for 60% to mid and small cap and 40% to the large cap.
Okay, so that's actually quite a strong skew towards the mid caps as well that you're looking at. And if I had to break that up further into, let's say, percentage of financials versus percentage of infra sectorally, can I push you on that as well?
Sure. So I think I would definitely prefer to be more stock specific rather than sector specific, because what we have observed, that some sectors will do well, but within that company may not do. Like for instance, just to give an example, banking did extremely well in 2022. But if you look at the Bandhan Bank was down near about 7 and 8%. Something very similar happened with pharma. While some companies, the pharma did not do well, but some companies within the pharma, like Sun Pharma, did very well. So I think rather than focusing more on the sector, I would prefer to be more company specific. But having said that, I think IT looks promising. So I would definitely have some pick from the IT. I do believe that pharma should do well because since 2015, they have not really done well and they've been struggling to command the respect that they used to command before that. So I would prefer to put something from pharma as a part of my portfolio, definitely infra and capital goods. That one sector makes me really very, very exciting, and I would look forward to do that. For some reason, if the government of India gives some tax benefit to the in the personal income tax, I would prefer to have FMCG also in my book. And I think one thing which clearly going to play out going forward is a cement. Why? Because the way the consolidation is happening within the cement space, after Adani coming in and taking over Ambuja and ACC, I think a lot of acquisition can take place within the mid and small cap within the cement segment. Why? Because they may not be able to sustain their business operation to take on some of the likes of Ultratech and likes of Adani. So I do believe some of the mid and small cap within the cement stocks does make a lot of sense. And one thing which is an evergreen theme with me is a holding company discount. And I think that's one thing one can definitely look forward to have in the portfolio. So this is what broadly I would define my strategy for 2023.
All right, Sunil, great speaking with you today and taking us through all of those strategies and look forward to speaking to you again here on VTTV. Markets today having a down day, as Sunil rightly pointed out. It is really all about the FOMC commentary that we're awaiting with no clear idea yet of what they're going to say. But quiet ahead of that, 600 points down, a bit of profit booking, and that too especially in the broader markets as well, where perhaps we have seen a bit of a run-up of late. Metals, the top loser today. Real estate also taking a bit of a nosedive. PSU banks, so some of these pockets that we are seeing a bit of a nosedive coming in. IT also has actually tumbled a little bit towards the end of the session. So there you have it, some of the bigger losers in today's session, which, you know, all of the metal names, just when the global environment starts to look a little nervous again, first ones to go off the grid, as you can see there on your screens. From the broader markets, a few gainers as well. Of course, your FACT is top of that list every day. Likes of Apollo Tools, Rajesh Exports, Kaplan Point Labs, GNFC, Rallis, Havel, some of the names there. But limited, you know, like Divi's is up just about 1%, Deepak Fertilizer just up about 1%. Clan Pharma also just under 1%. Fertilizers were just really continuing to be a very, very strong theme in the market. Other sub-themes are pretty much quietened down today as markets await the FOMC commentary, which we are watching out for. And then, of course, the other big talking point continues to be the budget and really what to expect from there, as the countdown is pretty much on with less than a month to go for that. Now, let's take a look at what else you might hear from the FOMC today as well. It's the minutes of the December meeting. There's worries about, you know, commentary with regards to growth slowing down. We've seen tepid trading in overseas markets on the back of that already. And of course, any kind of takeaways or commentary or indicators on the growth outlook will also indicate the interest rate trajectory in the new year. And that's really what markets are watching out for, because waiting to hear whether we're going to start to see, you know, a slightly softer stance or a stall on those very, very rapid and sharp hikes that we've seen now in the last few months. So that's really what we're watching out for from the FOMC minutes at this point of time. And that's really what the entire market is pegged around at the moment, the rate trajectory and the high inflation scenario that we're seeing around the world. We've already seen a series of shocks from global markets, but you know, let's wait and see what the first indicator this year holds in store for us. Europe, however, is still up and about. It's not really looking too nervous at this point of time, but it's really all about the US recession that everyone has been speculating about and whether or not that's going to be something to worry about going forward. So we'll leave it there for now, but thanks for watching and stay tuned for more commentary here on Business Today TV. Big relief for film exhibitors. India's top court has ruled in favor of cinema halls, saying they're entitled to set their own pricing standards for the sale of food and beverages inside the hall premises. India Today's Kanu Sarda filed this report earlier today.
When it comes to food in theatres, many moviegoers have often complained about the overpriced popcorn and other snacks and